Hello everyone, and welcome to this edition of the NZX Virtual Investor Events. My name is Oliver Logan. I'm part of the Capital Markets Origination team at NZX, and we'll be hosting today's event. Today we've got three speakers. We've got Richard Milsom from New Zealand Rural Land Company. We've got Sinan Altug from Raycon Technologies, and we've also got Melissa Yiannoutsos from Booster and Booster Innovation Fund. First up, I'll introduce Richard shortly, but just a couple of quick housekeeping items. So the format is each speaker will have 10 to 15 minutes to speak, followed by a Q&A. So Q&A coming from the audience and from the floor, so please feel free to send through your questions in the chat box and we'll get to those at the end of each presentation. The whole session, is recorded, so we'll be on YouTube following this, so for anyone who wants to rewatch or isn't able to make it live. And just a general disclaimer that none of the content is going to be considered financial advice. It's all just general information. So first up, we have Richard Milsom of New Zealand Rural Land Co. So Richard's the co-founder and manager of the management entity around Rural Land Co. Richard's got a diverse background in finance, strategy over a number of years, and has a number of kind of governance and board roles across the industry. So Richard, I'll hand over to you to introduce Rural Land Co and what you are doing going forward. Cheers.
Thank you very much, Oliver. It's a pleasure to be here with you all today. I thought what I would do is, in the interest of time, we've got an introduction to New Zealand Rural Land Company presentation. I'll run everyone through some highlights of that and then open it up for Q&A. Now, one question is, can everybody see my screen?
Yeah, we've got it.
Right. So, New Zealand Rural Land Company is a relatively new company. We listed on the New Zealand Stock Exchange at the end of 2020. New Zealand Rural Land Company, or NZL, which is its stock ticker, owns and leases some of the best farmland in the world, offering an unparalleled investment opportunity. Now, why is it without parallel? Well, it's a perfect combination of advantages. So, a rapidly growing global population, food demand, and a decrease in available productive land means that rural land is an increasingly more attractive investment, and the scarce and critical food production infrastructure has demonstrated really strong, consistent positive returns over time. Where New Zealand comes into that is New Zealand has the most productive agricultural land in the world, and it's because of our water, soils, space and climate. They all come together to provide the most carbon efficient and the lowest cost production of a whole bunch of crops and protein globally. So NZL, New Zealand Rural Land Company, invests in land, not the farm operation. So there is no direct exposure to anything operational, environmental, or commodity price risks. We own the land and lease it long-term to really high-quality operators. We currently own just under 12,000 hectares of high-quality land. If you think about a hectare as being about the size of a rugby field, including its surrounds, just under 12,000 hectares of high-quality productive rural land, and it leases it long-term to high-quality tenants. So our shortest lease is 10 years. NZL is the only pure play NZX listed exposure to agricultural land in New Zealand, and it means that you can own New Zealand rural land in a liquid way, as in you can trade it on the NZX, and it's an inflation hedged investment. For overseas investors, it means that NZL is one of the only ways they can get exposure to New Zealand agricultural land. Otherwise, if you want to own more than 25% of a farm in New Zealand, you need overseas investment office approval, which is almost impossible to get. All of the free cash flow from leases is passed out to shareholders via a twice yearly dividend, plus you get the growth in the value of the land. Since listing in 2020, so 2 financial years, NZL had a track record of outperforming the broader rural land market. Now, when you're thinking about NZL, it's important to understand why New Zealand rural land is such an excellent asset. So New Zealand's the world's most efficient and lowest cost producer. So when you're thinking about a resilient asset, being the lowest cost producer really provides you a great deal of buffer against any volatility in the short term in food prices. New Zealand's sustainably advantaged, so it's got the lowest carbon footprint in the world for a number of proteins and crops that it produces. It's got world-class risk mitigation from an environmental, animal welfare, political point of view, and it's a very well-advantaged exporter who's also positioned extremely well for free trade. So it makes New Zealand, in the face of a growing worldwide population and increasing importance of productive rural land and food scarcity, it makes New Zealand an exceptional place to own that rural land. So if we look at New Zealand Rural Land Company today, a bit of a snapshot, like I said, we're just under 12,000 hectares of rural land. Our weighted average lease term is just under 10 years. We own just over 6,000 hectares of land in Canterbury, just under 4,000 hectares of land in Otago, and approximately 1,400 hectares of land in Southland. Our occupancy rate is 100%, so nothing is vacant, and we have 7 large high-quality tenants. We expect that diversity of land class and geography and tenant will continue to grow as the company grows. Here's a short timeline since our IPO. So we listed on the NZX in December 2020 with a $75 million IPO, and as at today we have just under $300 million worth of assets. Here are some high-level key statistics at that 30th of September 2022. So $289 million worth of assets, $125 million in round numbers of market capitalisation. There is a net asset value per share of $1.61. The share price today is anywhere between $1.05 and $1.10, so providing an excellent value investment. Currently pays a net dividend of approximately 3.34%, which is forecast to continue to grow, and it's only 35% geared, or borrowing makes up 35.2% of total assets. I won't labour the point on each of these slides, but let me run you through New Zealand Rural Land Company's advantages as a company as a whole. So these advantages, there are 5 core advantages of New Zealand Rural Land Company: sectoral, sustainability, structural, risk management, and returns. So in terms of our sectoral advantage, we've touched on this. We're operating in a sector that is due to benefit from a growing global population, an increasing scarcity of rural land and productive rural land per person, and the fact that New Zealand rural land is extremely well placed to capitalise on the global scarcity of high quality land. In terms of sustainability advantages, we've touched on this already. New Zealand's got some of the lowest carbon footprint per unit of production, be that milk, meat, lamb, versus anywhere in the world. And additionally, New Zealand Rural Land Company only selects tenants that have a track record of environmentally sustainable performance. So we select very high quality tenants to sign up to long-term leases. Our joint sustainability commitments are written into our binding leases, and these reinforce the shared vision between Rural Land Company and its tenants. And all of the directors and management have a track record of establishing and implementing sustainability initiatives across a number of New Zealand businesses, and I'll touch on our directors and management later on. Rural Land Company also has a structural advantage itself as a business, so because of its size, its profile, and its volume of transactions and its network, it does get access to transactions off market and before others do. Being a listed company and having a strong banking relationship, we do have access to more capital than others, meaning that we can operate in a size of the market that others don't necessarily have access to simply because of the size of the check. Because we're a domestic company, New Zealand owned, it means that we have no OIO restrictions, and so have an advantage as a domestically domiciled New Zealand buyer. And because we've been doing this for quite some time and have a long history of being involved both in asset due diligence and agriculture, have a proprietary and advanced due diligence and lease structure. And our network and our availability of high quality tenant partnerships really sets us apart. And so that's a virtuous circle of structural advantage that we think will be enduring for the company's life. Then moving on to risk management advantages. By being a landlord and not involved in the operations, there's no direct exposure to the operational risks of farming. And when you compare being a landlord of rural assets versus being a landlord of urban property, there are a number of advantages. If there's easy and low cost alternative use, if you own an office building in town, short of repurposing it for apartments or doing something that's quite expensive and takes a lot of time, your alternative use is quite low, quite expensive, quite time consuming. If you own a farm that is grass paddocks and currently it's being used to graze beef animals or finished lamb, next month for no cost you could be cropping or dairying or something similar, because you're effectively just buying highly productive grass producing paddocks. And so that does mean that your alternative use is reasonably costless and immediate, lowering your risk profile. Dealing with tenants with high credit quality, so very strong balance sheets, which is a condition of our leases, provides a lot of mitigation against tenant default. Rural land assets also have much less depreciating improvements. So if you think of a piece of land with a big building on it, a lot of your money is tied up in a building that over time does depreciate and require refurbishment. With rural land, the vast majority of your money is tied up in soil and pasture, which doesn't depreciate, continues to regenerate over time. There's a low risk that tastes or technology will render a productive farm obsolete. People are always going to need food. Their tastes might change, but if it's a productive asset that can grow a variety of food classes, then you're reasonably insulated from that risk of it becoming unfashionable or out of date. Food production remains an essential service, and so in the face of things like COVID or other disruptions to normal life that we might not predict, food production still needs to grind on. And over time, and it seems to be forecast to the future, that rural assets provide very strong inflation hedges. Both the asset value itself and all of our leases are CPI inflated, uncapped leases. In terms of the returns that you can expect, so as we mentioned, there's two elements to the return that you would expect from an investment like this. Here is the growth in the value of the asset itself, and here is the lease income. So if we talk about the growth of the asset itself, rural land, you can't make any more of it. It is a productive asset. We've talked about the risk mitigants on the previous slide. Over the last 25 years, rural land has compounded its annual growth of just under 7%. If you look to the right-hand side, you can see the growth of New Zealand Rural Land Company's net asset value per share, which was 11.7% in its first year and 18.6% in its second year. We don't expect this to continue at this higher rate, but we do expect that rural land will provide an attractive long-term store and growth of value in the asset or the farm itself. And on top of that, you would expect for healthy, attractive, risk-adjusted returns from your lease income, and those leases are inflation linked with no caps. So you would expect the leases to grow on a cash basis with inflation as well. This slide touches on New Zealand Rural Land Company's performance versus the farming index, which shows the farming index has performed well. New Zealand Rural Land Company has performed slightly better, which is buying high quality assets and buying them well. This slide talks to our dividend forecasts. So our dividend in 22 was 4.3 cents of AFO, which paid a 3.61 cents per share dividend, and with a growing forecast and continuing to grow forecast of long-term lease income, which translates into dividend income, bearing in mind that our leases are very predictable. They're at least 10 years long each. They're all inflation hedged, and so you know what you've got a lot of transparency and predictability around your cash flows. In terms of Rural Land Company's portfolio overview, I touched on this earlier. We own land in Otago, Canterbury and Southland. We've got 7 tenants and 100% occupancy. You can see here that the diversity of tenant and the lease expiry profile is reasonably diverse and will continue to get further diversified as we grow as a company. We publish in our regular updates in terms of the rural land asset subsectors, being dairyland, free range poultry, forestry, green energy, viticulture and horticulture. We publish a bit of a heat map about where we think the most attractive opportunities lie, being the dark green at the top. An operational update as of the 26th of August, so last time we put out an operational update to market. The things that we're focusing on at the moment are increasing our biodiversity, so looking at the least productive bits of our large portfolio and looking for further riparian planting and biodiversity increase, as well as looking at areas of farm that would suit to be planted in trees and sequester carbon. Looking at further infrastructure efficiency, so if we can implement and also utilise more efficient water distribution or effluent distribution equipment, not only is it good for the environment, but it's accretive in terms of earnings to New Zealand Rural Land Company. And on sustainability, there are a lot of contractually obligated and quite exhaustive sustainability initiatives that we take that are part of our leases and part of our day-to-day operations. We're just working on articulating that and being able to publish our balanced scorecard on those things that are already taking place. In terms of the company structure, New Zealand Rural Land Company is externally managed by New Zealand Rural Land Management, and the directors of New Zealand Rural Land Company are Rob Campbell, Sarah Kennedy, Tia Greenway, and Christopher Swasbrook, one of the other co-founders who's a management company representative. Bios on the people involved. Director of Management Ownership, so we collectively own 20% of New Zealand Rural Land Company, so strong alignment with investors. As we've touched on, New Zealand Rural Land Company is a highly advantaged buyer in New Zealand because it doesn't need to go through any overseas investment office approval, and currently our overseas investment of our register is about 22.23%. Here's a high-level overview of our sustainability program, which we've termed Enduring Land for Life. So at the heart of our company is it's a commitment we follow in all of our business dealings, and the idea being that we want to create and protect enduring land for life by applying 5 principles. So we've got our environmental sustainability, we've got our economic resilience, social integrity, animal welfare responsibility, and then strong governance and inclusion ties that all together and ensures that not only is it happening, but it's being improved, it's being reported on, we're constantly leading as opposed to following the pattern. So our next step is to report on within each of these pillars. There are a number of independently audited and reasonably exhaustive initiatives that take place that we're bound to, that our tenants are bound to, and so starting to report on those. And so with that brings me to the end of my introductory slides, and I thought that I would take questions from here.
Right. Thanks, Richard. Very good. We do have a few questions that have come through. As a first one, could you possibly just comment on the advantages of the model that's been set up in terms of how New Zealand Rural Land Co is structured both in terms of how it's advantageous for yourselves, but also possibly for operators, for the lessees, in terms of them being able to move away from a model that was traditionally quite highly leveraged, and put operational pressures on them when there weren't, commodity prices, for example, weren't in an advantageous state.
Yeah, absolutely, Oliver, and that's a really good question. So, in the past, the only way to continue growing your farming business was to buy more farms. And if you imagine that a reasonable sized farm is anywhere between $12 and $25 million, that's a lot of money to come up with. And the capital of choice for New Zealanders historically has been debt. Now, with every single business in New Zealand, we think about some of our innovators, like Raycon, who's on the call, and Rocket Lab and things like that. If they had to own every single business, every single building that they ever wanted to operate in, they wouldn't have any money left to focus on the things that they're really good at: people, research and development, sustainability initiatives, etc. And so what we tend to have is we have tenants who are reasonably large, successful businesses. They tend to own some farms already. They've got an infrastructure team, they have sustainability managers, they have farm managers, they have a reasonably big operational footprint. And for them to grow and continue to invest in people, to continue to provide jobs, provide equity opportunities for people to come up through the industry and build equity, for them to be able to lease a farm means that they require less capital to continue to grow their farming business. To lease a farm, you need to buy some plant equipment and some cows. To buy a farm, you need to buy the farm itself, $12 to $25 million, and the plant equipment and cows. So these very well capitalized big tenants can lease, continue to grow, apply their really elite operating model and sustainability initiatives over a much bigger platform and scale faster than if they were forced to buy every farm. Plus, it's less risky because you don't have the debt burden hanging over your head, so that every time there's, what we've seen over the last 25 years is the value of all foods have gone up, but they don't go up in a straight line. There's volatility associated with that. And so every 8 years, 10 years, you're going to have a low payout. That's just part and parcel of the industry, and that's the risk that you face. If you've got an enormous debt burden hanging over your head over that time, you're focusing less on your operations and more on staying alive, dealing with the stakeholders, dealing with the bank. And so this way it allows farmers to focus on what they do best.
Right, yeah, perfect, thank you. And two more very quick ones. One just around sort of climate, obviously topical area, and recently government proposals around pricing of agriculture emissions coming out. Could you possibly just quickly comment on any impact you see from that, and whether the kind of carbon neutrality piece of New Zealand Rural Anchor, whether you're already there or aiming to be there in the future?
So so the first question was just general comments around the around New Zealand's carbon position and effects that we think that might have. So what that's likely to do is that there are some farms in New Zealand that probably shouldn't be farms. They're reasonably unproductive, and so the amount of carbon it takes to produce a unit of milk, meat, outweighs the benefit of that food that it produces. There are other farms in New Zealand that are really highly efficient and productive, and so for every unit of fuel that a tractor might use, or every herb or fart that a cow might put out, that farm can produce a lot of food for that very small footprint. And so they're highly productive, lowest footprint in the world for those units of food. And that's what we should be aiming for. And so we think that high quality productive farms will continue to be valuable and probably get more valuable, and we think that some unproductive and less sustainable farms, and most of those have gone by the wayside anyway, will become less valuable. And so we're pleased that we own and will continue to own quite high quality productive assets. In terms of carbon neutrality, so we pledge an endeavour to continue to get better. So, we talked about sustainability initiatives earlier on. There are two main environmental impacts that farming has, and a lot of businesses have in general, but farming is the only thing that we've got, and food production is the only thing that we influence over. And so water quality is one, and greenhouse gases are the other one. And so if we're partnering with able, efficient, and sustainable operators who have a focus on bringing those emissions down, every farm that we buy, at least to someone with that focus, that's not owned and operated by someone without that focus, is another farm added into a portfolio and a group of New Zealanders that are focused on continually trying to improve. And that's at the core of our business, is continual improvement. And that's why we want to put out our scorecard, A, so people can see a reasonably comprehensive and wide-reaching initiatives that are taking place, but also so that we can be held accountable. And we can see it's not just words, they're not just platitudes, but there are very measurable greenhouse gas and water quality initiatives that provide measurable benefit that we are improving on all of the time. And so are our quality tenant partners.
Right. Thanks, Richard. We do have a couple others, but we'll have to send those through, and we will get answers for the people that ask those questions after the webinar. But thank you very much for your time, Richard, and we will move on. So welcoming you next is Sinan Altug. Sinan is current CEO of Raycon. Raycon, for those who aren't maybe familiar, designs and manufactures advanced frequency and timing technology solutions in sort of sectors ranging from sort of telecoms through to space applications, so sort of advanced high-tech company. Sinan has been at Raycon for 20 years now, so knows the business inside and out, and has previously had a number of roles across the US and in New Zealand and across European operations as well. So Sinan, welcome in, and I will hand over to you to present.
Hi, well, thank you. Hi, everyone. Pleasure to be here. I guess I want to start with our thanks to the NZX team for the invite. I guess I need an invite from you to present. Is that correct?
Yes, correct. Yep.
Great. Just wanted to check whether this works fine. Can everyone see my screen?
Yeah, we've got you now, Sinan.
Okay, great. Well, that's great. Well, starting with a quick introduction to Raycon. We're an NZX listed global technology company and a leader in our field globally. We design and manufacture advanced frequency control products. These are used by all modern electronic systems, including all communication systems, all electronic infrastructure, satellites, etc. Our products generate the time and frequency, which effectively are the heartbeat of these electronic systems. So they enable, as examples, the next generation speed and 5G networks, precision positioning for autonomous vehicles, synchronization for cloud computing, and instantaneous communication between Earth and the satellites. And when we say we are a global leader in our field, we really mean it. If you go back in our history, Raycon was established in 1967, and we have been a technology innovator for 5 decades. Our products have been enablers for numerous industry firsts, including the first generation cell phones in the 80s, GPS satellite navigation systems in the 19s, smartphones for positioning and navigation in the 2000s, and 3G, 4G, and onto 5G infrastructure in the last 2 decades. And when we look at the decade in front of us, we have cloud computing, 6G, new space, autonomous vehicles in our radar. So we are a company deeply rooted in our past, but with our eyes firmly on the future. Just to show where our products reside, here is a cluster of 5G base stations on a cell tower. and that's a depiction of where our products go into. And another one, this is the Mars Perseverance rover on Mars, in which we have two components. Perseverance landed on Mars last year, but we shipped those products about 8 years ago. And looking at our core markets, we have three core markets. The biggest one is telecommunications. This market represents 50% of our revenue, and with a substantial year-on-year growth, really. And it's steadily improving margins. The picture that you see on the bottom left is fueled by the ongoing 5G rollouts, but also our ability to achieve improved margins from our newer and more advanced products, which incorporate our own semiconductor chips. Space and defense in the middle has been a steady market for us, where we achieve our highest margins. But this market has also been a key driver of performance and innovation for Raycon. And the new space market now forming around low Earth orbit satellite constellations represents an important growth opportunity, as I'll touch on a little later. And looking at the positioning markets, where precision, automation, and performance are the key words, we are seeing the tangible benefits coming from our pivot from the lower commodity sub-segment of this market to the higher performance, higher margin end. This transformation has paid off with increased revenue and also healthy margins. This is a market where we have global leadership in areas such as emergency beacons, as well as autonomous farm equipment, etc. And customer partnerships is a major competitive strength for Raycon, so it deserves a mention. As I love to say over and over, our customer list in every core market that we participate is a list of who's who in the global tech world. And I think that's a real competitive advantage for us. We work deeply with them to understand and cater to their current needs, but more importantly, we actually evolve our products, our roadmap, and develop technology based on their next generation requirements. When you look at the makeup of our customers, our top 10 customers contribute over half of our total revenue. And more importantly, as you would see on the left, 2/3 of our FY22 revenue came from customers with whom we have 10+ years of business relationships. And also two additional competitive strengths that I want to touch on, as they are an integral part of our strategy. One is the emphasis that we have on R&D and technology innovation. Our own proprietary semiconductor chips are the key drivers of innovation in our products. We are actually the only company globally that has its own semiconductor chip development team. And part of that team is in the UK, and part of it is now here in New Zealand. And also our homegrown XMEMS nanotechnology, which was developed right here in New Zealand, enables miniaturized products with new levels of performance. We have a pipeline of new products for next generation applications using our innovations. And we are planning to further increase our investments into R&D up to 12% of our revenue. And the second major competitive strength is our world-class operations in New Zealand, France, and India. To support our growth, we continue to expand our operations here in New Zealand, and we are also building a new factory in India. Overall, our proactive supply chain management and the vast 60% increase in our New Zealand throughput that we had last year were the two primary factors in my mind in achieving record earnings last year. And the last 3 slides clearly state our strategic priorities, but I just want to maybe recap it in short. So starting from the top right, We position ourselves in high growth, high tech core markets, and we build leadership through technology and product innovation. We form solid and enduring relationships with major customers globally, and we scale our operations in accordance to the demand, manage our costs, and tap into talent wherever it's available in the world. This has been simply our winning recipe. And speaking quickly about our FY22 highlights, FY22 was actually, for a manufacturer like us, it was quite a challenging year, but we did exceptionally well. We achieved record financial performance, which I'll touch on the next slide. And we continued to grow our revenue and our earnings. We saw strong core business growth, including in 5G. And we also captured, apologies for that. And looking at the bottom left, we also successfully captured a multitude of additional growth opportunities, some through the global chip shortage. And we have navigated the supply chain risks well. As I mentioned, we actively managed our inventory, our product pricing. We successfully worked through supply chain disruptions and capacity constraints. As I mentioned, we increased our capacity in New Zealand by 60%. And the challenge there was to actually capture the demand, increase the capacity, and turn it into revenue and earnings for the company within the same fiscal year. It required flawless execution, which I believe we did well. And finally, we commenced our new factory construction in India, which will significantly increase our capacity. It's going quite well. It's in accordance to our plan. And financially, as I mentioned, FY22 was a record year, our best year ever, where we reached $172 million. This is a New Zealand revenue. And that corresponds to 34% year-on-year growth. And we also more than doubled our EBITDA to $54.4 million and quadrupled our net cash. As these plots attest to, we have established a very healthy 5-year track record. And this is it's a result of our strategy that we have rigorously executed in the last 5 years. We did release our FY23 guidance around our annual shareholders meeting about 2 months ago. That guidance would put us on track for FY23 to be our second highest earnings year, and more importantly, our highest ever core market earnings year. As we have entered our blackout period, I apologize, but I can't talk too much into our half-year results. But we will have our announcement on November 24th. And we have some exciting potential future growth ahead of us. We expect the demand for 5G to sustain for the good part of this decade. We also expect a substantial expansion in our serviceable markets due to the convergence of cloud computing as well as data centers with 5G. And further, we're investing heavily into R&D, as I mentioned, to maintain our product leadership position in 6G as well. Space markets represents a substantial growth opportunity for us too, as the new space, or as the space market rather, transitions over to new space formed by low Earth orbit satellites. The requirements call for space reliability at telecom infrastructure pricing, and this combination plays right into our strengths because we are leaders both in traditional space as well as telecom infrastructure in our own field. And also for positioning, we see significant growth opportunities in a variety of areas. These include autonomous vehicles and autonomous industrial machines, emergency beacons, and others. So the future prospects truly excite us. And my final slide, moving forward, we are taking decisive but careful steps to take Raycon to a new level. We have a clear growth strategy formed around 4 key objectives. So we are investing heavily into organic growth, and we will maintain and grow our product and technology leadership in core markets. That's a given for us. And we're also looking into expanding into new markets. We would like to ideally develop 1 or more additional markets to a serviceable size as big as telecom infrastructure for Raycon. These new high potential markets, as I mentioned, include new space, autonomous vehicles, cloud computing. And also, as a 4th crucial growth strategy, we are going to continue to deliver world-class manufacturing. As a manufacturer of components and subsystems, this is a key for us. We need to determine where and how we expand our capacity and look at our manufacturing capabilities to make sure that we optimize and strengthen our margins and extend our product life cycles. And finally, again, organic growth being our main focus, we will also explore accelerated growth through M&A. We're actually exploring potential value accretive opportunities that will support our strategy. For instance, we're looking at opportunities that may give us improved access to markets, customers, technologies, or talent. Of course, when we evaluate any potential external investment, we will ensure that it's strategically sound, value creating, and resilient. And that is all I wanted to present. Thank you.
Great, thanks, Sinan. That's very interesting and good insight into the business. We do have a couple of questions that have come through. Which would be good to buy through. So it's just the first up. Could you comment on what percentage of revenues are recurring revenues? So you commented on existing, long-term relationships with customers, and how does that translate through to recurring revenue?
So as I mentioned, quite a big chunk of our business is coming from those long-term customers. When we talk about recurring revenue, I guess probably the reference is to the one-off profits that we had last year due to being able to leverage some of the chip shortages in the world. I think we have quantified those numbers in our fiscal year results. I would invite to look at our last fiscal year results. They are there. Moving forward, quite a big chunk of that business, and I'm kind of sensitive because it requires now for me to tap into making forward-looking statements for the half year that we just completed. So I refrain from doing that, but I'll be happy to further detail this at our announcement. But quite a big chunk of that ongoing revenue is actually being compensated by our core business growth, as I mentioned, and specifically the telecom infrastructure market thus far.
Great, thank you. And the other one was obviously you've commented on the importance of R&D and product leadership, which Raycon's been doing for a number of decades. An important part of that will be patents and securing your IP over those certain technologies. Can you comment around what your processes are there and how extensive your patent sort of network is, I suppose?
Right, that's a good question because it's important in our field. We have, I guess we have quite a rigorous process in place that actually, so we have a formal innovation process, if you will. It's not based on, hey, we just brainstorm and something comes up. It actually is a strict systematic process that moves forward. And within that process, we actually ensure that anything that we should patent, we do. Now, there is a balance there, I must also add. The balance comes from the fact that when you patent something, then it's out in the open. So there are some things that we do that include our innovations in them that we choose to keep as trade secrets, because sometimes it takes longer time for our competitors to get an understanding as to what is being done. But we do have a rigorous patent protection process in-house.
Great. Perfect. Thank you very much for that, Sinan. We'll move on with Melissa shortly, but thank you very much for your time, and we will see you again soon.
Sure. Thank you. Cheers. Bye.
Cool. And so next up, we're going to have Melissa Yiannoutsos. Melissa's from the Booster Innovation Fund, and she's manager of the fund. For those who aren't familiar, I'm sure Melissa will introduce in detail, but Booster Innovation Fund essentially invests in a diverse portfolio of sort of early stage New Zealand tech companies, tech in being a very broad term, but and Melissa's the manager of that fund. So Melissa's experience comes from public and private sector commercialisation of sort of science, coming through universities, etc., and has also got experience on sort of governance and executive level roles. So Melissa, I'll hand over to you to introduce yourself and Booster Innovation Fund. I think you might be muted, Melissa.
Thank you. Great. Oh, well, thanks, Oliver, for that introduction. It's really good to be part of this session today and introduce the Innovation Fund. Sorry, let me just getting that out the way. So I've been, as you noted, in the science, commercialisation and investment space for about 20 years now. So I've been across all sides of what it takes to kind of build a young company. I joined Booster about 2 years ago now, and it was really to help launch the Booster Innovation Fund, which we're covering off today. So just standard disclaimers that this is not an offer, but really to provide some general information about our fund. So for those of you who don't know Booster, we're about coming on 25 years old. We were established in 1998 as under the name Grosvenor. And so we've built up over the many years into what you know today as Booster. We've been reappointed as a KiwiSaver provider as well, so that was quite an important milestone for us. We now have about $6 billion of funds under management, and what really drives a lot of what we do in the direct investment space and is very much underpinned by Alan Yole, who founded Booster, is looking at ways to see how we can direct New Zealand capital to grow the New Zealand economy. And this effort really started back in 2017. So just to give you a sense of how much of our investment activity sits in that direct investment space, it is at that 7%, so a modest allocation, and we have that supporting 3 direct investment funds. So we've got our Tahi, which supports profitable businesses and primarily in that agricultural sort of productive assets. And then we also have a private land and property fund. Again, this is really supporting that agriculture sector and also some other companies. And our newest listed fund is our Booster Innovation Fund. And this is really geared at supporting tech companies which have been an asset class retail investors haven't been traditionally able to access. So just to give you a sense of the New Zealand landscape, I've included this graphic here, it's old, but it just gives you a sense of the growing value of New Zealand companies. There'll be some familiar logos up there in terms of the Rocket Lab, Xero's and LanzaTech. So the New Zealand investment community has invested 250 million in the last year. And so you're sort of seeing this activity and the investment landscape maturing. So if you are qualify as a wholesale investor, there is a couple of ways to get in earlier to support these companies. But if you aren't, then your options to support these kind of companies is limited until we set up the Booster Innovation Fund, which is really geared about making it a real option for all Kiwis to support these great New Zealand companies and to get in earlier before the point where some of them may list on a public exchange. But if not, it's very difficult to kind of share in some of those successes. So the Booster Innovation Fund, as I said at the outset, is about investing in young, unlisted New Zealand companies. We go under the ticker code BIF. This really is focused on individual's investment portfolio with a long-term investment focus. The other thing that's quite important around this particular fund is that we look to syndicate with other investors, typically those that would be specialising in that particular sector or have some other expertise that gives some further momentum around that company's future plans. This fund is deemed at the high risk of our risk profile, and it obviously will give that potentially higher returns. What we've also enabled through this scheme is a way for Boosters KiwiSaver clients to also get a small exposure into this particular fund, and that's a tiny exposure in terms of less than 1%. So it's really looking at how we create multiple ways in to support young New Zealand companies. The other thing that's quite different in what we've been enabling is a way to facilitate some liquidity, and which is often a very illiquid asset class. So the current key facts on the fund at the moment, where is fund size of 11.3 million, and that's really grown from our when we launched listed on the NZX in March, from about a 6 million fund size value. So we have a supervisor across this fund, which is a public trust. So we haven't taken it lightly in terms of stepping into creating this fund. We have invested over the last 4 years in building up a bit of a portfolio and partnering with 2 universities, Victoria University and Otago University, to really build up and support young companies that are forming off scientific research at those 2 universities. That's really grown, and that really gave us the framework and the momentum to launch the retail fund, of which we did in early 2022. We now have 26 companies in the portfolio. That when we launched the fund, we had 14. So we've really seen a steady building up of that portfolio. And what we're quite keen to really achieve is getting to at least 40 different companies in the portfolio to help manage the inherent volatility in the startup sector. So we've got a range of companies there that are seeking to improve healthcare and save lives. We've got companies in there that are looking to find ways to improve the environmental impact, also looking at improving clean technology solutions. So there's a real breadth of companies that are all emerging out of the New Zealand's innovation sector. So the other way that we're looking to manage risk in this asset class is to really make investment decisions that see a spread of the type of companies by age. So companies that are at the seed stage, tend to be at that riskier end in terms of likelihood to succeed. They often have a great technology concept and are moving forward to prove that there is a market fit with their product offering. And as they mature and they achieve and have that reach into different markets, they start to move in what we define as early stage. So some of those are starting to be revenue generating, and there's a real clear evidence there that the market wants what they've got. And then from that position, we have a set of companies in the portfolio that are what we deem expansion phase. So they're getting a foothold in the market and they are now looking to build out that leadership position. And so what you can sort of see in that fund value by stage is that where the opportunities are less proven, high risk, we aim to have a smaller level of exposure there. The other way that we're managing that volatility risk of investing in young companies is by sector. So you can sort of see a spread there, which is being balanced across the life sciences and medical technologies, energy and clean technologies, and also some software companies. And what that allows is to see the fund support a lot of different companies that create sales and revenue in different ways and have different environmental factors which govern their success. So for example, in medical technologies, there's a regulatory pathway required before some of their medical devices or drugs can enter into a clinical setting. So that's a different commercialization pathway to a software company where there is that early signs of revenue generation compared to some of those other sectors. So they have different capital demands and different dynamics. So that's the other way that we're looking to help manage risk and when you're investing in young companies. So I'll spotlight a couple of companies for you just to give you a bit of a sense of the kind of companies in the portfolio. So we invested in Elementary. This company, they sell medical devices, and what they've managed to achieve is to measure your electrical signals in the gut. And so that's really key in terms of helping them and inform the clinicians to be able to help diagnose gastric conditions. So if you think of your ECG for your heart, this is very much a tool which is similar but measuring the electrical signals to determine gut health. They are really kind of gaining momentum in kind of what they're doing. Their company's underpinning science originated out of Auckland University, and they've been steadily growing from strength to strength and building out positions in New Zealand and also in the US as they've gained regulatory approval in order to be able to sell their devices into that clinical and hospital settings. So we co-invested alongside specialist investors in this particular investment, so like the likes of the Movat Fund, IP Group and the Matu Fund. So we're in a syndicate of very experienced investors who are equipped to help support this company's growth long term. So they've also been recognised locally and took out 3 awards at the High Tech Awards recently. So we've got some rising stars in the portfolio in terms of the potential of Elementary. We've also thought I'd pull out and spotlight Biolumix, another great company. They are in the expansion stage. What they've managed to do is actually harness the power of UV light. So they have lighting systems and recipes which can really supercharge seeds and seedlings to really optimize their growing potential and the yield that those plants produce, and then also help with their improving their disease resistance. So this particular innovation originated out of Massey University a few years ago, and they are also being recognised internationally and are a finalist in one of the prestigious awards known as the Food Planet Prize. So again, we've got these great New Zealand companies that are being recognised in niches in terms of what they're doing. In this particular one, we invested alongside an agri-tech specialist investor, Finisterre. So again, we're supporting companies that are also supported by a depth of capital to help achieve their goals in growing into the international markets. So there's plenty of stories. We've got 26 great companies in this portfolio. So do take the time to look at our product disclosure statement to sort of learn more about what they're doing. So I thought it'd be useful just to kind of talk a little bit about how the fund operates. So the key things to bring your attention to here is that we have a number of relationships in the New Zealand landscape from those organisations that are producing great innovations, and also relationships with the investment community to ensure that we've got a really high quality pipeline of opportunities that we can consider investing in. So we have a series of investment decisions and considerations as we move through to a formal decision. And some of that really is about the quality of that team, the quality of that New Zealand innovation, the quality of the investor partners that we would be syndicating with, and also how far are they along in terms of the evidence that the market wants what they've got. So there's a few attributes that we look for to consider investments. Then we've got advisors that kind of really provide their view around some of the opportunities that we're considering. And that's chaired by Jenny Morrell, who's quite a known VC veteran in the New Zealand landscape. So we've got good expertise and balance and skills that are kind of providing that input into the final investment decisions. We then have the investment committee that considers this and approves the decisions. And then finally, the public trust also look at each investment to ensure that the compliance and framework in which those transactions are completed are fit for purpose for this fund. And then post-investment, we've got a regular monitoring of those companies' performance and also determining their valuation, if there is any movements in value as we've placed those investments. So there's a couple of ways that you can invest into this fund. So there's direct via the Booster Innovation Fund, and also there is the ability via the New Zealand exchange. So that was a really important factor for us in terms of creating this product, because we needed to make sure there was a way for investors to be able to invest alongside their investment goals and their investment timelines. Whereas traditionally, when you invest in a young company, you have to wait for them to create some liquidity. But under this structure, you get that diversity across many companies and also the ability to invest alongside your time horizons. So the other thing that's quite unique around how we've stood up this fund is the fee structure. So what we've done is set a high hurdle rate in terms of that being at 10%. And any returns above that are subject to a performance fee by the fund. So you can sort of see there in the table that it's not only until returns exceed 15% that you start to see the VC type fees start to come into play there. Prior to that, there's the no management fees, which is unique in terms of this asset class. And then you can sort of see as the returns build beyond that 10%, you can expect an annual charge of about 1.5 or 1.56%. And that was quite key for us in terms of how to stand up a fund which was accessible and affordable to the retail investor. So there are three ways to get potential liquidity in investing in this fund. So there's obviously the trading on the NZX. There's occasionally there will be proceeds from the individual companies' activities. So if there's an exit, so if, for example, one of the companies was purchased by an international, that generates some returns, and that can be disposed of to the investor base. And then the other way that people can move in and out is if there is the limited quarterly redemption windows. There is a withdrawal fee on this because the fund holds limited cash, and it's really about encouraging people to take a long-term view around investing at this end of the market. So in summary, we've stood this fund up, the Booster Innovation Fund, to create a way for all Kiwis to be able to support New Zealand's future. We've done it in a way that we can create some liquidity in what's traditionally known as a illiquid asset class. It's very much underpinned by a co-investment and partnership approach, so syndicating with specialist investors. Because, as you would have seen, we spread across multiple domains. We don't invest in that deep domain expertise across all sectors. We have that attractive, unique fee structure. Again, this fund is high risk with potentially high returns. And then obviously, you can find more information at our website in terms of the full product disclosure statement. So really, to quickly sum this up, this is really about how we support New Zealand companies creating high-value jobs and building more value locally as these companies build out into international markets. And a way now that we've sort of really seen the New Zealand investment landscape mature, it's really timely to kind of bring in a product that leverages that and allows retail investors a responsible way to get some exposure into this class, this asset class. So that's a quick kind of dash through the Booster Innovation Fund.
Great, thanks Melissa. We do have a couple of quick questions following on. You've kind of touched on it a little bit already, but what do you see as sort of the role of the fund playing in terms of supporting innovation in and around New Zealand, and maybe more specifically, is there a role beyond providing capital that the fund provides in terms of assisting with governance or anything like that?
So we are a passive fund, so we really have been deliberate to partner with lead investors who do sit in that governance role. But post-investment, what we do on a more informal basis is look at how we kind of help build those companies' visibility, so telling their stories. And I think that is also an important piece where companies need to build profile as they look to build out credibility in other markets as well. And often these companies don't have that resource or ability to kind of tell their story. So that is kind of one way, and then we have a lot of other different instruments that we can provide.
Great, thanks. And one other quick one is just around, I suppose, a lot of these early stage companies might burn through capital relatively quickly. So what sort of a role do you play in, maybe follow-on investment, or as they're going to seek further rounds of capital raising or potential takeovers in the future? What role do you guys play in there?
One of the decisions at the front end is to really consider who we are syndicating with. So quite often the lead investor does have some of that reach through in terms of follow-on capital. We do have our Tahi fund as one example. So if not all the companies would qualify for that fund, but certainly opportunities to kind of reach into that or flow on to that, because we do sort of think about that family of funds for direct investment. So that is one mechanism, but it's not fit for all the companies that come in at the innovation fund level.
Great, thanks very much, Melissa, for your time, and very informative, and see you again soon.
Yeah, thanks everyone, and thanks to NZX too for hosting us.
No worries, and that brings us to the end of today's webinar. So thank you everyone in terms of the audience for attending. As we mentioned at the top of the webinar, there will be a recording available in about a day's time for anyone who wants to rewatch or may have missed parts of it. Outside of that, the next webinar is going to be on the 9th of November, so make sure you tune in for that. There'll be an invite going out shortly. And thank you very much for attending, and we will see you next time.